And thank you for joining us today for Utilizing Low-Income Housing Tax Credits and Introduction. Our speaker for today is Elizabeth Bramlet of Liz Bramlet Consulting LLC. Having worked in the development and compliance components of many housing programs, Liz consults with developers, syndicators, and property managers to create strategies that maximize the value of their property's tax credit allocation. Liz is a nationally recognized expert in the field of affordable housing. She speaks regularly at conferences sponsored by the National Council of State Housing Agencies and to individual state housing finance agencies to share her expertise of the Low-Income Housing Tax Credit Program and other programs that support affordable housing. And so with that said, I would like to turn the webinar today over to Liz.
Hello, everybody. I'm very happy to be with you today, even if we are not in the same room. We're going to spend the next hour talking about the Low-Income Housing Tax Credit Program and how it is used by developers to help finance the creation of affordable housing, a very important topic. So let's begin with just an intro to the tax credit program. It's been around since 1986, so it has now become a very mature program. A lot of approaches have been tried and succeeded. Some have tried and failed, but we've learned a lot over these last few decades. And definitely, this is a program that is designed, it's a federal housing program, but it's designed to help drive private investment into affordable housing. It incentivizes private sector actors, most of them institutional investors such as banks, insurance companies, pension funds, etc., to invest their money into affordable housing. And over these last few decades, the tax credit program has been involved in helping to produce or preserve way over 2 million affordable housing units. Now, what is a tax credit dollar? Well, a tax credit is better than a tax deduction because a tax credit is a full dollar for dollar reduction in the federal income tax liability of the owner, therefore reducing the federal income tax they have to pay over what we refer to as the 10-year credit period. The investor gets to apply their tax credit dollar against each tax credit dollar against their federal income tax bill for each year of the 10-year credit period. So we have a simple example here just to help us make sure we all understand what we're talking about, those of us who are real new to the program. We've got an owner, and we think of owners as individuals, as people, and it can be easier to talk about owners as individuals to help us understand the program, but do keep in mind, again, that most of the investors are large institutional investors. In this case, we have an owner. I have a small project. They've received a tax credit allocation, and the way the numbers work, they will receive a tax credit equal to $1 million for each year of their 10-year credit period. And this owner's tax liability otherwise, they've done their full income tax return for the first year of their credit period, and they're on page 2 of their tax return, about midway down, and it says that they owe Uncle Sam $3 million. But then underneath that part on their tax return, it asks them to apply any credits that they have coming to them. And because this particular owner has a $1 million credit coming because they've secured one by investing in a low-income housing tax credit project, instead of owing $3 million in taxes, they only owe $2 million in taxes. Now, a developer, such as many of you who are in class today, you want to be a part of the tax credit program because it allows you to attract equity investment to help you finance projects you'd like to bring to fruition in your communities. The investors who are going to benefit from the tax credits, they have to join you in the ownership of your project. To benefit from a project's tax credits, you have to be part of its ownership. So the investors, they purchase a share in the ownership of one of your projects in exchange for benefiting from the tax credits that that project will produce. And with your ability to attract these investors who are putting money into your project to get these tax credits, you are able to create a project, but do so by borrowing less money. So you end up with a lower debt service for your project, so you can operate off of lower rents. And that's how this program is designed to help create and preserve affordable housing. What kinds of activities might you be thinking of being involved with and secure an allocation of low-income housing tax credits? Well, you can secure an allocation of tax credits to help you finance the acquisition of an existing project, something you see out in the community that you believe will be a good candidate for this program. But you can only qualify for acquisition credits as long as your project is also going to qualify for rehabilitation tax credits, because the IRS will not let you purchase a junky project using tax credits and leave it junky. If you acquire an existing project, you also have to rehab that project so that you bring it back to something like new again and extend out its useful life as an affordable housing opportunity. You can qualify for rehabilitation tax credits for an existing project regardless of whether or not you also get acquisition tax credits. So if you have a project and you're planning not to sell it to a new partnership or a new LLC, you're going to maintain the current ownership, you can get just the rehabilitation tax credits to help recapitalize that project. And of course, you can also get low-income housing tax credits to help you finance new construction. Very important if you want to be part of this program and utilize it to help you serve your mission, you need to be able to work through your state housing finance agency, because it's through your state agency that you are able to compete and secure an allocation of tax credits. Every year, each state issues what they call their Qualified Allocation Plan, their QAP. And each year in their QAP, they give their description of how they are going to score the applications for tax credits that they've received from developers that year. And this is important for you to understand because most of the state housing finance agencies receive 3 or 4 times the applications that they can fund in a given year. So it truly is a very competitive process, and you want to study that QAP so you can understand how you can structure your project so that you can win out in that competition for tax credits. Very important for this group today, 10% of the credits a housing finance agency awards on an annual basis must go to properties with nonprofit sponsors. And they are always looking for capable nonprofit developers with the capacity to bring these projects to fruition and then manage them through the compliance period. The nonprofit must materially participate in both the development and the operation of the project. So in order to get the tax credits through this special set-aside, you have to be prepared to be involved with this project for a long term. And some of the state agencies do elect to allocate more than 10% of their credits to projects with nonprofit sponsors, and it is certainly their right to do so. Also, over the past 10 to 15 years or so, more and more of the states have in some way made sure that some of their credits go towards the preservation of existing affordable housing. So most of you are located in rural areas. So you have, 515s and 535s under the Rural Development Program, and you also have some project-based Section 8, and you can certainly find 236s and 202s, HUD-insured and HUD-financed projects in the rural communities. Well, if you are interested in recapitalizing one of those kinds of existing properties, one way to look to do so would be going through the Low-Income Housing Tax Credit Program. In this program, there is definitely an incentive to maximize how much of your project is going to be occupied by low-income residents. Because the bigger the percentage of your project that is occupied by low-income tenants, the bigger the tax credit you will receive, and the more investment you can attract from your investor partner. And when you receive your allocation from your state housing finance agency for your tax credit project, the credits are actually usually allocated by building. So you want to know for each building how much of that building can produce a tax credit based on the allocation you received from the state agency. And as a developer, you are always interested in maximizing the value of those credits by renting the number of units covered by that credit allocation from your state housing finance agency no later than the end of the first year of your credit period. The portion of a building that is occupied by tax credit residents is officially calculated at the end of that first year of the credit period. So that's the reason you want to meet that goal. You want to get all allocated units rented to qualified residents no later than the end of that first year. Now, we were talking about the end of the first year of the credit period. The credit period lasts for 10 years. It usually begins the same year as you place the credits in service for that building, but you may elect to begin the credit period the following year. In addition to a credit period, you have a compliance period, and that initial compliance period lasts for 15 years. And the first year of your credit period is the first year of your compliance period. And you might be thinking, well, that's strange. Why do we have a 10-year credit period but a 15-year compliance period? Well, the IRS allows you to take your credits over 10 years, but it takes you 15 years to actually earn those credits. So you do definitely need to comply for the full 15 years. If you fall out of compliance in a significant way, say in year 12 of the compliance period, you may have to give back some of the credits that you have already taken on your units all the way back to the first year of the credit period. So it truly is a 15-year compliance period. You also have this thing called an extended use period that also begins in year 1 but continues on for at least 15 years beyond the close of the 15-year compliance period. And in an extended use agreement that has to be recorded in the public record, you commit that you will continue to operate this property as an affordable property under some system for at least 15 additional years. And the compliance requirements might be a little bit looser than they were during years 1 through 15. But you've still made a commitment to your state agency that you will be expected to live by, that this will be an affordable property under some definition at least through year 30. Okay, a guest is asked, I hear some states have longer compliance periods. Why is this? Who's ever asking? That's a very astute comment. It's true. Some of the states have 50-year extended use periods. I've seen 99-year extended use periods, 45-year extended use periods. The reason that they do this is because they're trying to stretch their resources. If they put tax credits, which is a valuable resource, and they only have so many to go around, if they put those tax credits into a project, they want that project to be an affordable housing opportunity for the people who need it in their jurisdiction for as long as possible. So if they, and if they say have 45-year extended use periods, if you want to secure an allocation of tax credits in their jurisdiction, you just have to agree to a 45-year extended use period. Because if you don't agree to it, another developer will. Because, again, it's a very competitive process to win an allocation of tax credits. All righty. Any other questions anybody would like to submit to me before we move on to part 2? Okay. What about the term remaining useful life? Based on the definitions listed on the contract, this appears to mean forever. Can a property with that term of RUL ever get out of it? That is an excellent question. It is a legal question, so if it's something that's of concern to you for whatever reason, I would definitely have an attorney who understands this program review your particular contract so they can see, based on the terms of your contract, can you ever get out of it? I know certainly people who've had 99-year extended use periods have been able to go in and talk with their state agency and negotiate changes in the terms of that contract. So you want to keep that in mind. And I've also heard at conferences attorneys say that you really can't have an indefinite, an extended use period of an indefinite period of time. But legally there does need to be a definite period of time written into that contract for it to be something that people can really be held to. So you want to keep that in mind. And also, there is a provision in Section 42 of the Tax Code, which is where we find the tax credit regulations, that say that you can, at the end of year 14, you can offer your property up for sale, and the state agency has then the job to try to find an owner who will buy the project and continue to operate it as affordable housing. And if the state agency cannot find a buyer, then under federal rules, you have the option to then opt out of your extended use agreement after a 3-year decontrol period. So that sounds good, and it's true. That's in Section 42 of the Tax Code. However, I know lots of the state agencies have written it into their qualified allocation plans that if you want to score high enough to win an allocation of credits, beforehand you have to give up your right to ask for them to sell your project at year 14 and opt out of the program. So they're making it impossible for you to be able to do that in those states. And again, why are they doing that? Because they want these projects to be affordable housing opportunities for as long as they can make that happen. All righty. Determining eligible basis and qualified basis. Eligible basis means eligible costs. Those costs that are eligible to produce a tax credit. We're talking about the costs associated with building, renovating, purchasing a building. Includes both your hard and soft costs, must be depreciable cost to be included in basis. Usually the biggest cost that cannot be included in basis is the cost of the land, because as we know, land does not depreciate in value even if the building on top of it is falling apart. Now, you calculate the eligible basis at the end of the first year of the credit period, and it may include costs that you have incurred after you place the building in service, but you incurred before the end of that first year of the credit period. So if you placed in service in May and you finish your concrete work in October, you could include that concrete work in your eligible basis because you're going to close out the first year of your credit period December 31st. Now, the developer fee, very important, I would think, for everybody who is participating today. The developer is paid for conceiving of the project and being able to bring it to completion. The fee needs to be considered reasonable for your particular marketplace, and you'll read in your state's qualified allocation plan that most states limit how big the developer fee can be. Usually it's something around 15% of the total developer costs. The partnership agreement describes how you can earn your developer fee. It describes the duties that you must complete in order to be paid for your developer fee. And that's that partnership agreement between you, say the nonprofit sponsor, and your investor partner, the insurance company or the bank that has joined you in the ownership of your project. Now, usually your developer fee is the last cost paid out of your development budget. And if you want your developer fee to be included in eligible basis, which you definitely do, then the specific tasks that you perform to earn your developer fee need to be tied to costs that can be included in eligible basis. So, for example, this time you spend buying land cannot be included in a developer fee that goes into eligible basis because we said earlier the cost of acquiring land simply cannot be included in eligible basis. Now, for acquisition credits, you want to make sure that you have a structured sales contract because you want to be able to separate out the costs of the building versus the cost of the land, because the cost of the building is what produces your eligible basis for your acquisition credits, while the cost of the land cannot go into that eligible basis. Federal grants. Very important, particularly for nonprofits to understand. An owner has to reduce a building's eligible basis by the amount of a federally funded grant received prior to the start of the building's compliance period. All right, so if you get a grant through HOME in order to help you build your project, whatever, say it's a $200,000 grant, then that $200,000 has to be subtracted from your eligible basis. So most of the time what you would prefer, instead of getting a grant, would be to receive a low-interest loan through the HOME program, because that way, and it could be like a soft second, where there are you definitely have to repay it, but usually it's a soft terms as to how that is actually paid out of cash flow at the end of the year, something like that, the mortgage payment. But you would prefer that because that way it may be a loan that only carries an interest rate of 1%, but it does not cause any reduction in the eligible basis, so it does not bring down the size of the tax credit you can produce for your investor. Now, an owner or developer who is planning to develop a project through the Low-Income Housing Tax Credit Program has to commit to a minimum set-aside, where they commit to a minimum percentage of units at the project that will be rented to tax credit eligible residents. You commit to either the 20 at 50, where you say at minimum 20% of the units will go to folks with income no greater than 50% of the AMI, or the 40 at 60, where the owner commits to renting at least 40% of the units at the project to households with income no greater than 60% of the AMI. You have to meet the requirements of your minimum set-aside by the end of the first year of your credit period. If you are not in compliance, if your project is not in compliance with your minimum set-aside, the buildings included in that project cannot produce a tax credit of any size. Now, the minimum set-aside just sets out both the minimum percentage of tax credit units you need to be in the program and the income limit you will use to qualify them to produce a federal tax credit. We also then need to talk about not the minimum number of tax credit units you're looking at, but the maximum number of tax credit units you are really shooting for. In your negotiation with your housing finance agency, you come to terms as to how big of a tax credit each building will be allowed to produce, and how much of that building you are looking to qualify to produce a tax credit. Many commit to 100% tax credit buildings, meaning that the entire building can produce a tax credit, so you want the entire building occupied by tax credit qualified residents. And certainly most of the time, remember, you are always shooting to have many more tax credit units than those just required by that minimum set-aside. So here we have a single building property with 100 units. The owner committed to the 20 at 50 minimum set aside. The owner received an allocation for 70 units. So they need 70 tax credit units to claim any credits, because it's like you have to cross the threshold of your minimum set aside just to get into the tax credit program. But you want 70 tax credit units. You want 70 units rented to folks with income no greater than 50% of the AMI, because that's how you produce the maximum possible tax credit approved for this project. Your investors will then benefit from the maximum possible tax credit, and they will make the biggest possible equity contribution to your project based on your agreement with them. Now, I have a question here before I go on. Which is used more, the 20 at 50 or the 40 at 60? Good question. Most people would prefer to go with the 40 at 60 if they can, based on what they know they need to do to compete to win their credits under their state's QAP. Now, the reason I say most would prefer the 40 at 60 if they can make that work is because in this program, the income limit for the project drives the rents. So the bigger your income limit, the higher your possible rents. So most would be shooting to use the 60% AMI limit if they can. But again, you want to check your state's qualified allocation plan. Many times developers are able to secure an allocation of credits, beat out their competition to get those credits if they agree to use lower income limits to qualify their applicants and to calculate their maximum allowable rents. Now, when we're talking about how much of a building is qualified to produce a tax credit, we calculate this thing called the applicable fraction. And again, all it is that portion of a tax credit building, and it's calculated on a building basis, occupied by tax credit eligible families. And the applicable fraction is always calculated as the lesser of the percentage of units in a building occupied by qualified residents versus the percentage of floor space in a building occupied by qualified residents. And it is your goal to meet your targeted applicable fraction by the end of the first year of the credit period in order to produce the maximum possible tax credit. So here we said we had a building where they got a 70% credit allocation. So they're shooting for a 70% a 70% applicable fraction. So that means we're shooting for 70% of the units and 70% of the floor space to be occupied by qualified tenants. So you see, you need to plan that out to make sure if you've got 100 units, you want to make sure the right 70 are occupied by tax credit qualified residents so that your floor space applicable fraction is always at least 70%. And that's what we've got here. If the building's 100 units, cover 80,000 square feet, then you need 70 tax credit units covering at least 56,000 square feet, rented to qualified residents by 12/31 of the first year of the credit period. That's how you'll get the maximum value out of your credits. Now, that first year applicable fraction is calculated on 12/31 of the first year of the credit period. So any unit that is qualified by 12/31 can produce, by 12/31 of the first year of the credit period, can produce its maximum credit for the investor. All right, any other questions anybody would like to submit before I go on? All right, let's talk about the qualified basis. The qualified basis is that eligible basis we started off with, those eligible costs multiplied by the building's applicable fraction. The qualified basis is that portion of a building occupied by tax credit qualified residents. And a qualified basis is calculated as of the end of the first year of the credit period, and it sets the value of the credits for year one and the potential value of the credits for the entire credit period. So the first year of the credit period for every building is the critical year, because what you are able to do during year one establishes your potential value for the entire credit period, so it establishes the potential investment you can attract from your equity partners. Here we've got an eligible basis of $1 million, and 60% of this building was occupied by tax credit qualified residents. So we multiply that out, and that gives us a first-year qualified basis of $600,000. Now, the credit percentage and the equity contributions we need to understand. There are two types of tax credits. You'll hear them referred to as the 9% and the 4% credits. And right now, anyway, the way tax credits are calculated, when you do your actual calculations, it's never 9% or 4%. Those credit percentages float on a monthly basis. The 9%ers float between 7.9% and 8.5%. The 4%ers float between 2.9% and 3.5%. And the applicable credit percentage for each month is published in the Federal Register, and at some point in your allocation process, you will lock in on a certain month's credit percentage as that which you will use to calculate the tax credits for each building at your project. Now, again, it's published on a monthly basis, and an owner may elect to use the credit percentage the month they receive their binding commitment from the Housing Finance Agency for a future credit allocation. And you need to know what does binding mean with your state Housing Finance Agency, how they interpret that as they administer the program. We said you have 9% credits and 4% credits. The 9% credits are usually what we refer to as the competitive credits. These are the credits you compete for under that state's qualified allocation plan. And you can get these 9% credits, which we say currently are floating between 7.9 and 8.5%. You utilize these 9% competitive credits to attract the equity, to do new construction, and to do substantial rehabilitation. To qualify for rehabilitation credits, you have to meet a spending test. You must currently spend the greater of $6,500 per low-income unit, or 20% of the adjusted basis of a building. And usually most owners have no problem meeting that spending requirement. Most owners spend way more than that on development costs when they are rehabbing an existing project. You would select a period of time no longer than 24 months during which you would accumulate the costs to form the rehabilitation eligible basis for a particular building. And the spending test is applied on a building basis at the end of the first year of each building's credit period. Oops, sorry, I hit the wrong button there. Just a second. All right. To qualify for 9% credits, the financing for your construction cannot be considered federally subsidized. And there used to be a whole bunch of different programs that provided financing for these projects that were considered federally subsidized. That changed under HERA in 2008. Since HERA, the only financing that is now considered to be federally subsidized is the tax-exempt private activity bond program. So when you are financing a project with tax-exempt private activity bonds, it says that the 9% credits are tainted by the federal subsidy, so you can only get the 4% credits. Now, acquisition credits, the credits you get to help finance the acquisition of an existing project, those are always the 4% credits regardless of how your project is financed. So you're doing an acquisition rehab project, your acquisition credits are always going to be the 4%. The credits for new construction and rehabilitation is what varies between the 9% and the 4%. And you know, like we just said, if the financing, some of the financing for your project came through the proceeds of the sale for private activity tax exempt bonds, then your rehab or new construction credits are also only going to be the 4% credits. All right, any questions before I move on that somebody might like to submit? Which is used, guest is typing, okay. Do you see many rural deals with private activity bonds? That's an excellent question they're asking. The reason it's such an excellent question, and whoever the questioner is probably understands this. To do a private activity bond deal, your project has to be of a certain size because there are extra costs associated with bond issuance. There's bond issuance costs. There are extra legal costs, extra administrative costs that go with doing a private activity bond deal. So if you're doing small projects in rural areas, typically the private activity bond program is not going to be the way for you to go. Where I have seen it work is where I've seen developers who were doing a series of small projects in communities that were near each other. They financed them through one joint bond financing. And I've seen that in particular where nonprofits have owned smaller 202s in rural communities. And when it came time to refinance and recapitalize those older 202 projects, they took advantage of the tax-exempt bond program and did one bond issuance for several 202 projects, and that way they could spread those extra costs associated with bond issuance and the legal costs across several 202 communities. Alrighty, the owner multiplies the qualified basis for a building at the end of the first year of the credit period by the applicable credit percentage we were just talking about to calculate the tax credits for the first year of the credit period. Hit the wrong button again, just a second. Okay, there we go. All right, so the qualified basis at the end of year one was $1 million. They got 9% credits, and so we're going to leave that at 9% for right now. So that means they're projecting tax credits for year one of $90,000. They multiply the tax credits for the first year of the credit period by 10 years to determine the total tax credits projected to be generated by building. So we're talking about $90,000 a year times 10 years, total tax credit of $900,000. Now, typically your investor partner will own 99% of the project, and you want them to, because the bigger the percentage of the project that they own, the bigger the tax credit they benefit from, and the more they will contribute as equity into your project. So you want them to own as big a portion as possible. And so what we do to calculate the credits and the equity contribution, we have an example here. Total tax credits, we're saying, is $900,000. 99% of that goes to the investors. And the investors have said, and this is what they'll talk about, how much they will contribute per tax credit dollar they benefit from, and that's what you negotiate with them. And let's say in this case, the investor is going to contribute 90 cents per tax credit dollar. And see, it's that spread that produces their return. So you take the 900,000 times 99.99% times 90 cents, and it tells you that equity that you're going to raise through the syndication of the tax credits is $809,919. You subtract that from your total development budget, and it lets you know how much other money you need to beg, borrow, and steal in order to make your deal work. All righty. The first year of the credit period, we said, is critically important. You have to calculate the applicable fraction at the end of year one, but you also have to calculate the applicable fraction at the end of each full month after you place in service. because you have to calculate the average applicable fraction for the months in the first year of the credit period. And that is because the credit that the building produces as of the end of year one of the credit period has to be split between your investor's year 1 tax return and your year 11 tax return. You calculate the average applicable fraction for year 1 using the months in that year. And the owner may take the credits on the first year tax return representing that portion of the first year that the units were actually rented to low-income tenants. So you see there's an incentive here to get your units leased to the people who need them as quickly as you can, because the bigger your average applicable fraction for year 1, the bigger the actual credit the investors will benefit from in year 1, and that has a significant impact on how much they contribute to your property. The owner takes the remaining portion of the tax credit for the first year of the credit period on their tax return for the 11th year of the compliance period, or you'll often hear that referred to as on the back end. And when investors are thinking about how much overall they're going to contribute to their project, they think things like, we'll invest $1 for every tax credit dollar we benefit from and can actually take on our first year tax return. We'll invest 40 cents for every tax credit dollar we have to wait and benefit from and take on our year 11 tax return. So you want to do everything you can to create that split between the year 1 and year 11 returns to get the biggest possible credit on their first year's tax returns. All right, let's look at an example of how this works. We've got a 100-unit, 100% tax credit building that placed in service on August 1st. And we're expecting, the way the numbers fall out, that you're going to produce a $6,000 credit for each low-income unit that was rented during year 1. And so you're creating your applicable fraction, and you're tracking it at the end of each month. By the end of August, you got to 40%. By the end of September, you leased up to a 60% applicable fraction. 80% by the end of October, 100% by November. So you were at your goal by November of 100%, because this is wanting to be a 100% tax credit building. So your first year applicable fraction is 100%. So that means you're going to produce your full $600,000 tax credit for year 1. But the average applicable fraction is only, 31.67%, because you had it up the 40, the 60, the 80, the 100, and 100. And yes, you have to divide by 12 months, even though you're only in service for, 5 months. So that gave you an average applicable fraction for the year of 31.67. So your investors can take 190,020 as a credit on their first year tax return. They have to leave for a little over $409,000 as a credit to be taken on their year 11 tax returns. So there really is an incentive to get those units leased up to qualified applicants as quickly as you can. This impacts how much the investors will contribute to your project, definitely how big a credit they get to take on their first year tax return. All righty, syndication and ownership structure. Before we move on to this, any other credits anybody would like to, any other questions anybody would like to submit? Got somebody typing here. Do you see bigger credits from banks as opposed to syndicators? And I believe what Tom is asking is, are banks more willing to invest more per credit dollar than syndicators? And I don't necessarily see that. Maybe some people have experienced that, but it usually just depends on what the yield or the rate of return that's required for the investor for them to be willing to put money into the project. And you have some of the banks and some of the investors are looking to get their CRA credits, their Community Reinvestment Act credits. And that sometimes can influence what they are willing to invest because they want to make sure they get their CRA points if that's what they're looking to do. But that's not always the case because they don't always invest for CRA credits. Sometimes they're just investing for economic reasons. How do we get a copy of the presentation, handout, and summary? I know Shantaria will take care of that afterwards with you because she's very organized and will make sure that you get what you need. Okay, syndication is the process of raising investor equity and selling ownership in your affordable property. And remember, they have to join the ownership. They might be limited partners and you might maintain the daily management of the project, but they have to join the ownership of a project to benefit from its credits. You contribute your knowledge, your skills, your development skills, your knowledge of your community, of your market, the needs of the people you are trying to serve. You generally contribute very little in money. You're looking to other sources for money to develop your project, a primary source being the equity coming in from your investor partners. Now, most properties are owned by either limited partnerships where there's a GP, which is usually the developer, and then one or more limited partners are the investors. More and more we're seeing properties that are owned by limited liability companies consisting of a managing member who is the developer usually, and then one or more members who are the investors. And definitely if you're going to get involved with this program, you need good legal counsel and a good CPA, a strong CPA, both of whom need to be active in this program and understand based on all the specifics of your deal, because every single deal is different and many of these ownership structures become very, very complex. So you really need people who are professionals at understanding how these different ownership structures work and to help you set it up and make sure that your interests are represented well. The developer negotiates with the investor, could be a direct investor like with a bank or through a syndicator, the amount and schedule for the investor contributions. Of course, as the developer, you want them to contribute as much as possible, as quickly as possible, because the smaller and slower the investment that they put in, the more money you need to borrow for a longer period of time, the lot more bridge financing you might need, and the longer that will put off when you can collect your developer fee. Obviously, the investor wants to minimize their investment and to make their payments as slow as possible in order to maximize their rate of return. And this is definitely a market. There's not a regulation that says how much somebody has to invest per tax credit dollar. It is a market that ebbs and flows. Definitely in 2008, the market fell out. The bottom fell out of the market. Fannie and Freddie at that point represented about 45% of the tax credit equity. And so when they could no longer invest, that really suppressed the market for buying credits. And particularly, we need to understand, in rural areas, it was most acute where developers had a hard time attracting the equity they needed. That has certainly improved over these last few years. But you want to understand it is a market, and you, again, if you're going to be new at this program, you want to be working with somebody, an attorney who's experienced and can help you negotiate well and to represent your interests well. Here's a sample contribution schedule. If they're going to, say, put in $1 million, they don't just write you $1 million check. That their contribution is divided over, say, 4 or 5 payments. And you have to, based on your partnership agreement, you have to meet certain steps, certain points in your development process before they will make each of these payments. Okay, I've got a question here. Rural deals are usually smaller than urban deals with smaller margins. They certainly are. And may be self-managed and leveraging more sources. All very, very true. With diminishing home funds, how can we continue to make these deals work, particularly when competing with urban deals? It's an excellent question. There's no pat answer for you, no easy answer for you, for sure. Definitely you want to look to your state's qualified allocation plan to see what they are doing for rural areas. In some of the states, they set up different pools, and they have an urban pool, and they'll have a rural pool, and they'll have a nonprofit pool. And so you want to see how under that QAP you can best structure and set up your project so to give you the best chance of winning your allocation of tax credits. Certainly, you face a real challenge in making your deals work. You're always going to be looking for new funding sources. We don't know what's going to happen with the Housing Trust Fund. That was looking to be another source of funding for our projects, urban or rural. But you want to be able, but we don't know at this point if they're really going to fund the Housing Trust Fund. Congress is looking at telling Fannie and Freddie that they can't put the money into the Housing Trust Fund that they were scheduled to put in so we could start getting funding in 2016. So we have to watch those kinds of things. I wish I had a pat answer for you, but I don't. You definitely just are going to have to keep looking for more and more resources out there. Some non-government, some from foundations, for example, would be another place to look. I know HAC and other entities who specialize in rural housing have training and suggestions and recommendations for places you can look for more funding. But it will continue to be a particular challenge for you to make your numbers work because you just don't have those same economies of scale as they do in the urban areas to stretch out the costs. Again, one of the techniques I have seen work in rural areas is where you might have several nonprofits working together and they're in different communities, but they're going to work together. You get the lawyers involved to know how to do this legally, and they finance their projects together so that they have, one architecture bill, one engineering bill, et cetera, one legal bill, and they can stretch out the costs over multiple projects. I've seen that done with tax-exempt bonds where you really need to do it in rural areas, but I've seen it done when it's not a tax-exempt bond deal, but where they were just looking to get creative as to how they could make the deals work when you're trying to do it with such small numbers. All of you have very good questions. All righty. Each investor decides on the rate of return required for investing in their tax credit property. And they expect to receive, just really pointing to the question we were just addressing, they expect to receive a return through those tax credits. And they may expect an additional return through cash flow, other tax advantages, and through increase in the property value. And your developer fee is paid out if the money is available through their final capital contribution. The size and final payment will be impacted by, are you required to set up an operating reserve to prevent foreclosure? Because there'll be all kinds of provisions in your partnership agreement to prevent foreclosure, because foreclosure wipes out the credits. You might have to fund an operating deficit. There might be other reserves, residual receipts accounts, those kinds of things you might have to fund. And before they make their final equity contribution to your project, they will also always have their asset management folks do a review of your first-year tenant files, because it is so important what happens that that those tenants really started producing credits for you during year one of the credit period. They want to make sure all of those initial tenant income certifications were done correctly before they make that final equity contribution to your project. All righty. In part 4, we're running out of time here, but I'm just going to let you know what else is here for you to review because you all have access to this handout in addition to this recording. They just want to make sure you understand that the State Housing Finance Agency, they will underwrite your project at three different times during the allocation process. And the third time will be at the end of the construction process, where now you have all actual real numbers that you can submit. And you submit those numbers, you have to submit what's called a cost certification, where the costs involved in the development of your process is certified by a CPA. And they use those numbers in order to certify the total development costs of your project and to determine how big a tax credit you really need to produce in order to create a viable project. And again, they're always trying to stretch their resources, so they want to make sure that they allocate you a large enough credit in the end to create a viable project, but not too large a credit so that you don't secure excess cash flow from the project or too much excess cash flow from the project. And that, again, will all be spelled out in their qualified allocation plan. The underwriting standards, the debt service coverage, for example, that they will apply when underwriting your project and to see what sort of gap you have and how big of an equity contribution you need from syndicating your tax credits. All righty. This is all about debt service coverage, how they calculate the net operating income. Then they go to the debt service coverage. Here's an example here where they figured a project's NOI to be $530,000 based on what you're projecting to do in the financial structure of your project. Your debt service requirements are going to run $480. Divide that out. That gives you the debt service coverage of 1.10. So your NOI is 10% greater than the amount you need to pay your debt service. And they'll have a range of their debt service coverage that they will approve. Most of the time, they will probably see that as too low. If you have a case where the state requires a debt service coverage between 1.15 and 1.20, they won't allocate the credits as the project currently stands because they want more security built in. They want to make sure you have more money than that, just in case the rents run low or the expenses run higher than you're expecting, that you'll have more NOI available to meet your debt service requirements. Okay, I have a question here. Is there any special consideration of the contractor or architect for considering these deals? Definitely. Well, it's a good question. Well, it's a good general question, not just with these deals, but with any deal. Certainly you want somebody reliable. You probably want somebody who understands affordable housing and the issues you have to deal with when planning and constructing your affordable deals. I would definitely reach out to other people who have done these deals to look for reliable contractors who understand the sensibilities that you have to bring to affordable housing. Your state housing finance agency would probably have some information on that. But definitely you want somebody, my experience is, who isn't used to just doing market rate housing and is used to all the bells and whistles that they put into market rate housing and how you have to do things a bit differently in order to make your deals work. All righty. It's 3 o'clock. It went fast. I knew that it would. Again, you have a lot more information here all about underwriting and the end of the allocation process there for you to review. The last slide is all my contact information, or most of it. We all have so many ways to be in contact today. It's hard to remember. I'd be happy to answer any questions anybody has, and usually the best way to reach me is through email. And it's just liz@lizbramletconsulting.com. You're welcome to email me. All of you are going to receive an invitation to join my free list service. You are in no way required to join it. if you get the invitation and you want to receive information from my company, we send out information, updates on the affordable housing industry, and we do some marketing too. I want to make sure we market our classes and our other services. If you're interested in receiving that information, click on the link and you join our service. If you are not interested, which is completely your right to not be interested, just don't click on the link to join it and you will never get anything from us. Alrighty? I want to thank HAC for letting me be a part of this today. Shantaria, do you need to do anything?
Just a really quick wrap up to kind of see if folks had any questions for you, Liz. I saw that we did get a few questions, got quite a few questions in via the chat box during the discussion, but I wanted to allow folks the opportunity to ask any verbal questions really quick because there are some folks that are just on via the phone that are not logged in online. And so at this point, I am going to go ahead and unmute all the lines, but I would ask for those folks that are not planning to ask questions verbally that you go ahead and mute your lines locally so that we can avoid all of the feedback. And so at this time, Liz and everyone on the phone, I'm going to go ahead and unmute all the lines so that those folks that have verbal questions can go ahead and ask them at this time. All right, so do we have any questions from anyone?
I just got one in writing. Shelley is asking, what are the highlights of the differences between LIHTC and historic tax credits? One of the big differences between low-income housing and historic tax credits is on the historic side, compliance is not what we're going to talk about tomorrow when we talk about compliance for low income. For historic tax credits, compliance is all tied to how you do your construction. Do you meet the standards for that meet the historic standards for that particular kind of building and that era of building based on the Park Services standards for that area? And so you're not renting automatically to low-income people under the historic tax credits, but they are combined quite frequently. We have projects, a lot of projects that have both historic credits and low-income housing tax credits. So that, of course, attracts a lot more equity to your project, but you have then the compliance requirements, the low-income requirements of LIHTC, and you have to meet the historic building and construction standards for the historic credits. Also, the equity that you are able to attract through the historic credits reduces the eligible basis for the rehab credits on the low-income side, so that those numbers have to be factored in when you're running your numbers and seeing does your deal work.
All right, thank you. Any verbal questions for Liz? We're at 3:04 and want to give an opportunity, maybe 1 or 2 more minutes to ask any additional verbal questions. All right, having heard none, I just want to do a quick reminder before we wrap up. The recording and all material will be available on HAC's website following the webinar. Also, please be on the lookout for an email containing the link to your certificate of participation as well as a link to the webinar survey. I would also like to, again, thank everyone for their patience and understanding during our challenges last week for the webinar. So thank you again for coming back, joining us today. I also want to thank Elizabeth for the wealth of information that she's provided during this webinar. And Elizabeth, if you don't have anything else to share, I would just like to say thank you to everyone and have a good rest of your afternoon.
Bye-bye.
Thank you. Bye.